Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Monday, Macro Monday. Before we talk about the macro side, let's talk about institutional crypto flows, which have mainly been outflows. Report here from James at CoinShares every week. Greatly appreciated. He gets right to the chase here, doesn't sugarcoat it. Sentiment remains poor. Continue to see outflows here. And actually, if you dig deep in the numbers, it's, to me, worse than even what's reported at around negative 59 million in outflows, because we had 15.2 million in inflows to short Bitcoin. So yes, we had flows into crypto products, but I wouldn't call that because of, bullish sentiment. So I always like looking at this line specifically. Maybe they're hedging, maybe they're just going short, who knows, but pretty decent slug on the short Bitcoin BITI ETF, which I don't believe has even tracked Bitcoin very well, but it's something for someone to use who really has nothing else, on the institutional side. Anyway, for the rest of the video, I want you to think, anytime I say anything about anything, is it worth taking the risk if I can get 5.5% yield on a CD through Fidelity, through whoever, Schwab, doesn't matter who? You can get over 5% risk-free, theoretically, on cash. So keep that in mind. For Bitcoin, for ETH, for alts, for staking. Why stake, right? Why take that volatility risk? Currently, you can stake your cash and get 5%, okay? So you definitely have to keep that in mind. Talked about inflation yesterday, still hovering above 2, below 3 on Trueflation. CPI this week, consensus is probably going to be around 3.6 to 3.8 as far as what the print is actually going to be, which will be a month-over-month increase. I hope the markets are ready for that and they don't flip out. Next week, there will be a Fed meeting, unlikely to raise rates based on current probabilities here. We are starting to see some activity again at the 6% level as far as probabilities are concerned. But as we stand here, very unlikely to raise in the next meeting. And maybe we're seeing some dollar weakness this week because of the market pricing in no hike this meeting. This is a relative value trade here, the DXY specifically. It's dollar strength relative to other currencies. It's a basket. Just because things look bad here in the United States, they look worse elsewhere and much, much worse in emerging markets. So dollar continues to remain strong. Dollar likely goes higher over time. Trend certainly bullish, undeniably. Bit of a bear div on this in the moment, but also going to hurt anything that's risk on, including crypto, which is inversely correlated historically to DXY. A lot of chatter about when the Fed's going to cut rates, and as many have pointed out historically, when the Fed cuts rates, it's usually because something has broken. Things are blowing up. So we don't necessarily want to root for cuts per se. Maybe as bad as rates at this level are for the risk on, risk off narrative, cutting rates would signify something has truly, truly exploded. Will it be commercial real estate? Will it be something else? I don't know. Will they just spin up another program to save the day like BTFP? Certainly possible. But I think cutting rates for them is the last resort, considering where unemployment is and where inflation is. They still have some work to do. Now, if you don't follow Nick Timiraos of the Wall Street Journal, Nicky Leaks, as some people refer to him, he is the Fed whisperer. For the most part, he is where the Fed goes to leak sentiment within the Fed. Let's just say it like that. As he said yesterday, currently, Fed officials are turning more cautious about raising rates too high, right? So again, this is signaling, look, they're probably not going to raise this meeting, and depending on what Powell says, maybe not even in November. Another Fed official saying, higher for longer maybe, but we're going to take our time here and see what happens now that we are in restrictive territory. And Goldman getting all bullish on lack of recession here. Recession odds continue to go down from 60%, I think a few months ago, to 15% here now. Yellen saying she's feeling very good about a soft landing. We've got the word recession and earning calls down significantly of S&P 500 companies. So sentiment has gone from extremely bearish a year ago to things are going to be okay today. And just when you least expect it, we may be headed for the wheelhouse of when a recession is likely based on the previous recessions. So it's lagging, it's not over until it's over, and there's certainly no guarantee that because things have gone well so far, things will continue to go well. So we're not out of the woods yet on that front. On the jobs front, we are seeing some interesting metrics. If you want to look hard, if you want to look in T's apart, this is permanent job losses. They're rising. If you just look at the unemployment number itself, 3.8, continues to get revised higher because employment numbers are revised lower. But in any event, Game of Trade's pointing out here that spikes in permanent job losses precede recession. I think a lot of this data is going to be very hard to interpret. Not saying it's wrong, it's just going to be very hard because we're rubber banding back and forth. COVID, once in a 100-year event, swinging all the jobs numbers wildly up and down, and we're sort of trying to find that equilibrium again. But doesn't look great. Neither does this chart, which is potato quality, but basically it's saying the percentage of states that are showing rapidly rising unemployment claims relative to the previous year is starting to signal some trouble here and could be headed for recession type behavior if we compare it to previous periods, right? So this will still take some time. Now the Fed now stuff is not predicting a recession at all in any regard. Atlanta, New York, none of those nowcasts have any inkling of GDP declines. There's also this other conversation of who's going to buy our debt. We've got our liquidity in the United States, or treasuries rolling off the balance sheet, QT as it were. Global liquidity as a metric continues to decline. Now we're seeing declines in liquidity and a rise in US equities, which is kind of bizarre, but Bitcoin has certainly followed this liquidity picture, as Look Into Bitcoin points out here, specifically looking at the Fed balance sheet, periods of expansion and contraction, still in that contraction period. I think the question on everyone's mind is how low can the Fed realistically bring their balance sheet back down? I think many people assume that if they are very aggressive at bringing this down, there will be a liquidity crisis, similar to what happened with the mini regional banking crisis at this point. That could have been a canary in the coal mine, and we may see something else explode down the line, right? It's certainly not over. But for the most part, Bitcoin's largest moves, barring 2016 to 2018, has had a tailwind of expanding balance sheet. And the other two charts that have been making the rounds, besides the SPR chart, which I'm beyond sick of, certain people who couldn't even spell SPR before 6 months ago are using it to drum up some doomer narratives. But we've got Saudi Treasury holdings down and China Treasury holdings down. The question I have is this notional, or is this based on the amount of physical, treasuries they've bought? I assume it's a mix of the two. Are they actually selling, or are they just rolling off the balance sheet and not, re-upping? But again, the question comes, who's going to buy our debt? A lot of our debt, this is the maturity profile, is set to expire within the next 2 years. I think 50% of it. I don't know how they issue debt, how they decide duration when they issue it. I know recently they decided to keep it on the shorter end of the curve, which means higher rates, because they were worried about pulling from bank liquidity, but that's at the cost of increased government debt. I think many people are waiting for the day when they start to issue 10, 20, 30-year treasuries and then see what that does to bank reserves. But again, who's going to buy this stuff if the Saudis are selling and the Chinese are selling potentially? Again, I don't know exactly the details of these two charts, but who's going to buy? Where is it going to come from? Reverse repo is down to 1.5 trillion. So that certainly won't cover all of it. But it should be an interesting 4 years here going forward when all this stuff matures and debt payments still haven't been reeled in. Before we talk about the consumer, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. They recently enabled alerts. Yesterday, I added a couple alerts to my Bitcoin chart, and you can see those got triggered today. Depending which browser you're using, you can also enable web notifications. But if we want to add alerts to a chart, click anywhere on the chart, you'll see set alert at that level. And you have a few options here, at, above, below, depending on the function you're using that for. Create the alert. It'll pop up here, confirm on the bottom right. And once that level crosses, you will get a notification. It's certainly useful if you're trading any one of the myriad of altcoins here on USD, BTC, or ETH pairs. Set your alerts, take action from there, especially if you're waiting on a breakout trade. If you're waiting on something, for example, on Link USD, just something that comes to mind with a good horizontal level, right? If I want to set an alert at, let's do 836, okay? At or above, create alert. That'll just stay there until it gets hit or doesn't, right? But that way you don't have to come back to this chart over and over again and revisit where price is at. As for the consumer, another very popular chart over the past week has been this one. We've got revolving credit, basically credit cards, consumer loans, all commercial banks hitting all-time highs. We know rates for credit cards are at all-time highs, 25% thereabouts, which is payday loan type territory, I believe. So we've got a lot of debt with a very high rate, while the personal savings rate continues to decline. Now, some counter programming to that is this chart from Bloomberg that apparently the Fed, New York Fed, was highlighting that when the economy is strong and consumers feel confident, households tend to add to their credit card. Tend being the keyword there. So maybe it's different this time, but once we see credit card debt declining, which I don't know why we would, but once we see that declining, maybe we are in trouble versus adding debt nonstop. I don't know if it declines because the cards go delinquent. I don't know how they count that on the debt side of things, but in any event, New York Fed wants you to believe that this is a good thing. Apparently, that's my read anyway. We also have bank lending environments tightening, which Econometrics is pointing out. And many others have said that's usually a sign of recessionary conditions. So we are getting closer. We are inching closer week by week, month by month here. Jobs, credit, higher for longer. Certainly seems likely that some sort of recession is coming. Now, I've also seen a lot of student loan charts this week. This is probably one of the best that I've come across. Really hitting home that Biden and the administration have tried to extend the pause on payments many, many times. And now that those loans are officially restarting at the end of the month, and as interest has started to accrue this month, you're seeing a bunch of repayments. Now, I think it'll be interesting to see if this continues throughout the rest of the year. I think the people who have the money to pay the loans back are doing so first, right? Now, this just may be straight up, straight down, but we'll start to get delinquency numbers in October, and then we'll see how much trouble we're really in. So we don't quite have the data on that yet, but again, this represents money out of the system, right? You're either throwing money in cash in 5.5% plus, you're paying back your student loans, you're getting squeezed in groceries and food and energy. Just not a great outlook here for the U.S. consumer. I saw this wild graph on student loan borrowers by age group. Really, the 50 plus age group scares me a little bit. Knowing that those loans can't ever get expunged, essentially, from your record, and how are we paying this back for the older borrowers, but it looks like about 60% of the loans are from the 40 and under crowd. So it's certainly going to hurt their ability to purchase a home, contribute to the economy, etc. if they're paying back student loans. I mean, it's a trade-off, right? If you feel as though the only way to climb the ladder of mobility is to go to school, then you get student loans. And if that doesn't work out, you're just kind of boned. So it's pretty binary for a lot of people who get hosed at the end of the day, sadly. And if we look at housing, if we look at, as Jeff points out here, a consumer survey asking, are you moving to another home in the next year? And as he astutely points out, most of the houses that are fully paid off are certainly the boomer crowd, right? So they can move if they want to pay that mortgage, or if they want to pay the house in cash, because they don't have a 3% mortgage to even worry about, right? So again, the boomers keep winning. One day that'll change, but right now the boomers just can't stop this winning, that's for sure, because housing payments for the past 4 years continue to be higher than the year previous. Now, this is mainly because of mortgages at 7.25%, but housing prices have not come down as well. And I think, as we all know, the housing market has come to a complete crawl when costs are this high. Now, the good news for the renters is that rent has come way down, as Bolello shows here, monthly year-over-year percent change. And we're also seeing a significant slug regionally with negative year-over-year rent growth. Even annualized, we're seeing rents year-over-year come way, way down. So again, this is sort of post-pandemic, rubber band. But it certainly helps the people that can't afford a mortgage. And maybe the best news of this video is that we're continuing to see rental units under construction, in this case, the highest level ever. And the rent component of CPI is likely to continue to roll over. Talked about this like every video, but there's about a 6-month lag in rents versus the CPI rent component. So in the CPI equation itself, this may offset the energy and commodity rises I'm about to talk about here that are likely coming over the next 6 months. And then lastly, for housing, there was another survey asking home builders, what is your plan regarding housing starts in 2024? And all of this signals more building, build, baby, build. So that's really good for renters as well as anyone trying to buy a house right now. All right, let's move on to the S&P. S&P seasonality, as I think this horse has been beaten many, many times, but September seasonality historically is negative across the board, positive in Q4. It's a great chart breaking that down. As bar chart points out here, there's also some VIX seasonality, the volatility index. If we look at the bottom here, the average since 1990 versus average of the highest correlation of the years, we are due for a volatility event based on seasonality. A suggestion, not a promise, no guarantees, but I think this is also helping people remain cautious. As far as the businesses themselves and how are they being affected by rates, again, it's the haves and the have-nots, right? The businesses with tons of cash, Apple, whoever else, they don't really care about rates. They don't need to go out and borrow money, whereas the bottom of the S&P does need to borrow money and is doing so at an extremely high rate. So the spread and the gap between the haves and the have-nots in the S&P should continue to widen. Another problem here, back to the initial 5.5% conversation, S&P 500 earnings yield is less than 3-month treasury yield. This should say earnings yield lower than cash yield. But historically, as Game of Trades points out, that has been not a good time for the S&P. Now, it doesn't necessarily mean a massive negative decline, but it does hint at a bearish slant to things generally. If we look at the S&P, it wouldn't surprise me if we do eventually roll over here into the cloud, confirm some sort of head and shoulders pattern, and then make our way towards a 200-day moving average retest. I think the markets would just melt down, and sentiment-wise, they would take this very badly, but it's perfectly within reason. Mean reversion back to the original breakout, essentially level 4,200 not out of the question. Back in my mind, how does this affect crypto? Well, it shouldn't be good for crypto, that's for sure. So if you're bullish crypto, you want to hope that the S&P doesn't roll over. You want to hope that the S&P just stays flat or goes for higher highs. It could negate this head and shoulders that I was sort of calling on the last shoulder. We made a higher shoulder. We may make another higher shoulder. I don't know. But I wouldn't trade it as a bearish setup until it's into the cloud. It just doesn't look like it's leaning bullish here. This could make a bullish TK cross with price above cloud, which is a go signal. But my expectations here are neutral, certainly for the S&P, the same for the Qs. Even though this does look like it wants to make a higher right shoulder, it looks like it does want to cancel this out. Same applies here. Until this is into the cloud, it's probably fine, but I'm not going to sit in a long and expect, an all-time high retest or something. Currently, I like a mean reversion move eventually over bullish continuation. That doesn't mean it won't go to 410 before 350. I just think this setup is screaming caution. across the board. If we look individually at some of these, Apple, Microsoft, Nvidia, somebody was asking me about Tesla. Tesla actually gapped up today. It's kind of a mixed bag. Some of these look okay. Apple in the cloud, Microsoft in the cloud, Nvidia looks like, Nvidia is just a massive do not touch for me until this thing retraces significantly. But some of these have made moves back above the cloud, and I think that's what you're seeing, in the indices. But across the board, I think caution makes sense here. Again, because why? Why? You can go get 5.5% on cash, right? Sit out this quarter, come back in Q4 when things potentially look clearer, post retracement, post sideways chop, who knows? Amazon also looks very good here. But kind of a mixed bag all over the place. Now, commodities are a different story. I think the doomer macro people want commodities to rise because it helps them sell newsletters, but technicals also look bullish for commodities. Now, this is the commodity index from the Fred that is quarterly. Doesn't help you too much because it's kind of super lagging. So you have to find something that works for you. I finally found a ticker for the Bloomberg Commodity Index on TradingView. This is the futures for that index. On the left here is the components: energy, grains, metals, softs, which includes coffee, sugar, and cotton, and livestock. The TLDR here is zoomed out. This thing looks ready for higher highs to me. Looks very much like oil, right? Oil's already essentially made that higher high, but individually, many of these markets are roofing, screaming. So this looks incredibly bullish, and I can't imagine bullish commodities would be good for inflation, food prices, energy. That 6-month picture looks troublesome, especially if the Fed does have to continue raising. So just based on technicals, this is an inverted head and shoulders all day. This is likely a bullish TK cross here over the next couple of weeks, coupled with an edge-to-edge move in the cloud, right? This is some random time frame, but it's high enough that I'm confident enough that this commodity index probably goes higher. And if you've been paying any attention to some other very popular charts lately, people are pointing out that commodities are undervalued relative to equities. And if we just look individually, cocoa, people are in love with the cocoa, 12-year high, cattle field futures, all-time high. And of course, everyone and their mother is screaming about the SPR. And yes, we would rather have it and not need it than need it and not have it. It's an insurance policy. I get it. If we do need it and we don't have it, that's going to send energy prices soaring. I'm glad they used the SPR in the way they did. I'm disappointed they didn't refill it. I'm disappointed that they didn't let Trump add to the SPR when oil went negative. Mistakes were made across the board, okay? But sentiment continues to be bullish oil because of the supply bottlenecks. That's undeniable. Technicals continue to look very strong for oil, as I talked about yesterday. Adam and Eve here playing out. We had a failed head and shoulders on lower time frames, and we also had bullish Kuma breakout in July. We had Golden Cross late August. So all this stuff looks bullish for oil, and that's not even talking about the supply issues, the cartel, OPEC, yada, yada, yada. Eventually, we are likely to see some sort of inverse move with equities and energy. We haven't quite seen that yet. We've seen equities slow down, but something to think about is, okay, what if oil goes to 94? Is that how we get the S&P lower? Is that how we get the Fed to keep raising? Is that how we get inflation to kick up again, right? Or is the housing numbers going to offset, or, just as energy was offset or helped offset CPI lower by the SPR releases, are those rent components coming down going to offset this energy increase? We'll see. Lastly, just to talk about gold and silver, not really seeing anything super exciting on either of these charts yet. Still ranging, still held below resistance. Gold really is unexciting until it's above 2,000, much like Ethereum. Silver probably unexciting until it's above 25. So that's all I have for this one. Kind of a mixed bag across the board. I'm feeling more bullish on the likelihood of recession as people sort of get bearish. Maybe I'm just a contrarian here, but a lot of knobs and warning signs are starting to flash dimly. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.